everyone to Sonoma Brain Trust. I have my co-host, Mary Piasta with Hauser Veloso and Piasta, and Darren Blonsky with Sonoma Wealth Advisors. And it has been quite the month already, guys. Quite the week with the elections. And Darren, I just want to jump off where we left off last time. In our last video, we talked about the markets and are they going to be wrong for the first time in history, I think, in predicting the next presidential outcome. So were the markets right or were they wrong?
You know, the signals were slightly mixed. And I think what a perfect, representation, because it appears like we have a winner with President-elect Biden. However, that's, I guess, contested at this point, and we'll see how that contesting works out. But here's what the market said anyhow. If you remember from one of our last sessions, we talked about how the August 3rd value, historically, if the market is above the August 3rd value on November 3rd, that 90% of the time the incumbent wins. And then if it's below, then 100% of the time the incumbent loses, or 99.9% of the time the incumbent loses. And then if it's above 7%, then the incumbent wins most of the time, almost all the time. So this was your August 3rd value right over here. And if you look, November 3rd was right here. So the market essentially was below, and then that Monday opened up and started climbing. So that's election day right there. And you can see correspondingly, it's right on top of that August 3rd value. So it's like right there. So how we look at it, how we call it, I don't know. To me, that leans more towards the incumbent loses. But then as soon as Monday came into play, we had this just gapping market up. I mean, the market's just been on tear. So these are candlesticks you're looking at, and the green candlesticks represent an up day in the market, and the red ones represent a down day in the market. And so you can see this coming into that Monday. This was the second. The market kind of sold off in New York or stayed flat. It gapped up in the morning. So what's that mean? It means that London and the other futures markets pushed the stock market up, and then it opens up in New York here, and that's called a gap. And then it traded more or less kind of sideways to flat throughout Monday. And then Tuesday took another gap up, came into New York hours and traded up a little bit, then went sideways flat. But then really since then has just been on a tear, culminating in a huge move Monday morning coming into the market. You can see we moved here where we closed at 350, moved all the way up to an open at 362. That's a big move in the markets, and is pretty impressive. And so if we look at that on a daily time frame, you can see that green bar there. That was that green bar from Monday. It did sell off, though, very quickly thereafter. And so we came into New York, and New York got rid of it and dumped it. And we like to say that the smart money trades at the market close and the dumb money trades in the morning. And so when you have these huge gaps up, you get this FOMO. You get people chasing the market saying, oh, I better get in. It's going to take off. And then Wall Street slams them all in the face and sells them off. And at the end of the day, and takes their money. And that's a classic move on behalf of the traders and the big banks. And then we basically came into today and have traded sideways for a day, but a pretty important resistance area was tested. You can see this candlestick right here, and that held as support. So I'm really curious to see what happens at the close today. We're shooting this on Tuesday, October 10th. You're going to be looking at it on Friday. So we'll see where it goes between now and then, but we're at a pretty interesting shift. And what we're seeing is this shift between the stocks that did really well during the COVID time, and now we're looking at stocks that didn't do as well starting to turn over a new leaf. So if you can see down here, the XLE, so these are the energy. You saw that big move in energy yesterday. You also saw a big move in the financials as well. Those two areas are sectors. There's 11 sectors in the S&P 500. And those two sectors have not done well during COVID. Very different experience than, say, the technology stocks, which are up here. And now you're starting to see the technology sell off, and you're starting to see the financials and the energy start moving up. So that's a good, what we call sector rotation. We want to see that for a healthy market. That's a positive sign for a market that's recovering if we are coming out of this recession. But that does present some issues with the technology stocks, especially because they've done so well this year. You can see year to date, technology stocks right now are up 39% versus year to date energy stocks are down 39%. So two different stories, and we call that the K recovery, right? So if you have that move up and then move down, move up, and then you kind of have that bifurcation happen. So we want to see that kind of equalize out, and we're starting to see that rotation happen. It's going to be interesting to see what happens now with the vaccine. As you probably all heard, Pfizer came out with this supposedly successful vaccine. I'm on the fence with it. But anyway, that could become an issue for stocks because that might be an issue for the case for more fiscal stimulus. If we don't get more fiscal stimulus, areas like consumer discretionary are really going to have a difficult time. That's also going to make it more difficult for stocks like Amazon that have done really well. People might not spend as much because they'll have less disposable income. So lots of shifts going on. We're at a kind of a tectonic shift in the presidency, potentially tectonic shift in the markets, and potentially starting to see the end of the tunnel when it comes to COVID. We'll see what happens the next few weeks, but a lot happening out there. Now that I've put you all to sleep,
well, so Darren, it seems like there is a lot of movement in the markets. And do you think that some of it has to do with the legal challenges that have been post the election, or you think this more has to do with the other factors and tech sector, the things you spoke about?
You know, I think it's broader. I mean, I think at the end of the day, if you look at the vote spreads between Biden and Trump, it's going to be pretty hard for the Trump group to disqualify the number of votes. I mean, you think about it, when we had the whole Gore versus Bush issue in the Supreme Court, we were talking about 500 votes in Florida. That was it. Right now, we're talking about literally thousands of votes across multiple different states. Pretty difficult to argue that the market thinks that we don't have some resolve on the presidency at this point. Now, Trump is certainly blustering, certainly making some moves with the firing of his defense secretary yesterday. And we're starting to see some issues that he could create some chaos for the markets. But I think ultimately people will be very impatient with that chaos should it ensue. At least that's the hope, right? At this point. So I don't think the markets are really, I think the markets are pretty clear. Biden's the winner. Now what they're looking towards is they're saying, okay, what are those sectors that are likely to do better if Biden does win? Part of the reason, one of the arguments for why you saw the energy sector move up so much yesterday is that there's a belief that because of the Green New Deal type of legislation, whether or not the Green New Deal, quote unquote, goes through, but that type of legislation is going to constrain oil supply. And if it constrains oil supply, that will push up prices of oil, which will ultimately benefit the Exxons, the Chevrons, those companies out there. So actually have the opposite effect as you think it would, as we try to, quote unquote, per the last debate with Biden, transition away from oil.
So interesting.
Yeah.
And I think going back to the legal challenges that are going on, we've got some of Trump aides saying that he'll actually concede after all the legal options are, quote, fleshed out. So, you know, perhaps that'll provide some more just certainty in general with respect to what's going on in the world. And here in California with the election, we have two really big laws that have passed that are going to need some analysis over the next few months as they roll out. One is a follow-up to AB 5, which was the gig worker limitations, basically limiting the rights of folks to be independent contractors and roping in companies in that way. And now we've got the passing of Prop 22, which is reversing that effect. So there will be more flexibility for business. And then another kind of big, but again, towards California, there's going to be a shift in the inheritance tax, taxation and property transfers through Prop 19, which will have an impact on how people pay monies upon the transfer of properties at certain levels. And there are a ton of exceptions that will be analyzed, I think, before it rolls out in February. So stay tuned, people. I will be writing about that in detail.
It's always interesting when these propositions come out, right? Because I think if you're a normal citizen with half a brain on your head, you still struggle to understand what you're voting for. But what are the true implications of them, right? And how does it truly impact us all? Pretty tough to figure that out from them. So it'll be interesting to see now that they're passed, what actually happens in reality.
Right. It'll be very interesting. Chelsea, what's going on with the real estate market?
So with everything going on with the presidential election I've had, and I keep hearing a lot of people wondering how the real estate market is going to be impacted by, I guess we're still kind of in limbo on who our next president is, but ultimately how the real estate market is going to be impacted by the next president. And while each president offers their own policies that will impact the real estate market, like how Fannie Mae and Freddie Mac will operate, and the governors of the Treasury, and even tax incentives and credits like for first-time home buyers, largely the landscape of the real estate market has already been set by the current economic environment. So you've heard me say time and time again, we have not enough inventory for the buyers. And so right now we have this pandemic, which is making our homes more important than ever. So people are going out looking to secure a home, and now it's never been more affordable to purchase a home, even though, you know, the prices are up, the interest rates are still historically low. So people are continuing to take advantage of those low interest rates, and the inventory, or the lack of, is still pushing the prices up. Supply and demand, we all know how that works. So that is largely setting the landscape for the real estate market to continue with how we've been seeing it progress through this year and through the crisis, through the end of this year, and at least through the first half of 2021. Our weekly closed sales are still unseasonably high, and the California Association of Realtors predicts that we're going to have even more home sales in 2021, putting us on the fastest sales pace in the last 5 years. So the American dream is home ownership. And even throughout this crisis, as the California Association of Realtors rolls out their monthly survey to California residents on if they think it's a good time to buy, the number of residents who say it's a good time to buy keeps increasing or staying steady even throughout the crisis, even though, you know, we know a lot of families are still struggling, but there are a lot of people who do have the flexibility to move a little bit to a cheaper area where it's more affordable for them to purchase something. They have the option to work from home now, and these low interest rates, and just the need to have their own safe place, a place to call home, that's going to continue to fuel our real estate market. So regardless of the presidential outcome, we're likely not to see any changes, at least through the first half of 2021.
I wonder, though, with the vaccine coming, that if people start flooding back to the cities, right, there's a less push. So in areas like Sonoma that have had a lot of people move out of the cities, because there was this one floating around theory that everyone's moving out of the cities because of the fear of the COVID. And then this other theory is, well, no, actually, it's just people are having kids now and they're getting married and they're moving on with their life. They're transitioning out of the city, and it's just coincided, and COVID just sped up that process. It'll be interesting to see which one of those theses plays out. Because if it is the first, where people are just scared of COVID, you would think they'd flood back to the cities, and then we'd see a depreciation in pricing, at least in Sonoma County. I don't think that's going to happen. I think it's the latter than the first, but we'll see.
I think people are finding out that they can work from home and still make a decent income. And I know some companies are penalizing their employees for moving, but I think for the most part, these employees are finding that they could purchase a home and live a much more comfortable life off the income they're making while working from home. So I think that that'll continue to make the push of people leaving the city.
Now, let's not call it penalizing. Let's call it corporate restructuring of wages based on other criteria. I think companies absolutely have a right to look at their structuring and their profits and, you know, shifts accordingly. And yeah, I mean, I've been brought in on a lot of deals recently, and it's folks who are moving to the area. They're looking at, what they can get in the $4 million range or whatever. And they, what will that get you in the city versus what does that get you out here? There's a big difference, right? And the interest rates, even for the larger loans are still really low. Mm-hmm. So, until that changes, do we have any idea of how long these rates are going to stay low?
From the lenders and loan officers I've been working with, we don't really see kind of an end in sight right now for those loans. My cousin just refinanced her house and she locked in a new rate of 1.9%.
Who's your lender? That's crazy.
1.9% for how long?
1.9%. And so I was like, wait, are you going to how much is that making a difference in your overall monthly payment? Because they bought this house in 2008 or something. And she's like, oh no, we're keeping our monthly payment. We're paying this house off quickly. And then we're leaving California.
Wow. What a great, it's neat that they have clarity over that strategy. And 1.9%.
Yeah. What was it? How long was that loan for?
I didn't ask.
It's got to be 15 or lower. But maybe it's 7.
I don't know. I didn't ask. Because they had a really bad first experience when they tried to do a refinance earlier in this year with the lender just really dropping the ball. So they struggled a bit with getting all the balls in the right court. But yeah, 1.9%.
Well, I will show you the 10-year Treasury note, which is not necessarily what the mortgage rates are. And you can see we had this little spike in June, and we're hitting a spike right now. So, and you tend to see that when you see markets go up. And if you overlay this with the S&P 500, let me find a cleaner chart because that chart, it will make anyone.
So what does that mean, Darren?
What does what mean?
The Treasury cycle with the 10-year.
So this is how much interest someone gets paid if they buy a 10-year Treasury. And so you can kind of get a sense. And so if me trying to line up these graphs here, or these, you can see kind of in June, let's see if we can kind of get this. You can see in June when market spikes up, so does the yield, because if the stock market's going up, then what's happening is bonds offer more yield because they have to offer more yield to get people out of stocks, right? So it's a supply and demand of debt instruments versus equity instruments. And then you can see another equity goes up, and there's this big ugly candlestick I told you about yesterday. And you can see that spike up with the rates going up again. So right now it looks and appears to be like rates are going up again. But, who knows what's going to happen tomorrow. So,
right.
But just give you a sense of that candlestick I was talking about earlier. You can see it's on a different chart, and that's how fast price went up yesterday and then dropped. That's pretty bearish. That doesn't bode well for the markets.
So for the real estate market, though, it's probably long-term better if the mortgage rates and all that stay low, right? Because that's
correct. You don't want stocks to go up if you want mortgage rates to stay low.
Right.
And that's the point. And what we are seeing is rates go up because we're seeing the equity markets go up. And and it's not necessarily one-to-one correlation there, but it does have a degree of correlation.
So it's a good time to buy, right, Chelsea?
It is a good time to buy.
Get out there, get a great realtor, and start shopping.
If you like to borrow affordable money, go buy that house, guys, and call me.
Who likes to borrow affordable money? Ridiculous. Heresy. Well, should we leave it there for the week? Sounds like we've covered it. Any last thoughts for the good of the brain?
Ooh, I have one. So for all you incredible viewers out there, if you have questions for us, Brain Trust folk, submit them and we'll talk about them.